Beatrice, thanks very much for joining us. ARA Venn, obviously a specialist investment manager in European private debt. It would be good to get your sense of what role the debt funds are playing in the market at the moment, especially compared to traditional bank lenders.
Debt funds very much play a role where typically the banks are not active. It goes back to the great financial crisis. So before then, banks really dominated the market in Europe with about 98% of lending. And what happened during the great financial crisis is clearly the banks pulled back of the market, in particular, obviously, the commercial real estate market. And that created a big gap and a supply and demand imbalance, which meant that there was really good value in that sector and which brought the institutional capital into the sector. Debt funds have continued to be active and continued to play a complementary role into this market, acting where banks typically can't lend. So here we're talking higher LTVs, or we may indeed be talking into certain asset classes where banks are less comfortable, where there perhaps is some alternative risk or indeed some repositioning risk. Fast forward to today, the lending market is much more balanced. We have obviously the banks, we've got debt funds, and we also have institutional investors that investing directly, typically the larger ones.
And do you think, Beatrice, that the crisis has cemented the role of debt funds in the market?
Sure. I mean, every crisis means that there's typically a pullback in terms of lending, and that clearly offers some opportunities for those that are able to lend into a disrupted market. Clearly, with COVID, banks have stopped lending or have lent into much more conservative structures, particularly in the first few months where everybody was busy just analyzing their existing books and the impact of the crisis on their books. So, certainly from what we've seen, it's been an interesting market and a very attractive market because we've seen a correction in terms of LTVs that have come down quite a bit and the return that have been adjusted, which means that today we can find some really interesting pocket of opportunities at fairly conservative risk levels, obviously in an environment where there's significant risk. So one has to be careful in terms of underwriting, but there's certainly some really good opportunities, we think, for debt funds.
And you mentioned opportunities there, Beatrice. What are the main trends in the types of lending opportunities that you're looking at currently?
In terms of the opportunities we're seeing, which have been interesting, has been mainly the office sector, as you'd expect. That's obviously seen a lot of headlines in terms of the future of offices. So clearly some banks have retrenched from that sector, and we are being approached with a number of interesting opportunities there. Another sector which I thought was interesting, which possibly we wouldn't have seen much of pre-COVID, certainly not in the UK, was the purpose-built student accommodation, which we're seeing quite a bit of inquiries on. And then the sectors you would expect, so obviously hospitality, and retail and development finance were both parts of the market which were always underbanked in the last few years before COVID. So that continues to be very much in demand. Those asset classes that are well banked at the moment, probably logistics and residential. So we're seeing less demand on those two fronts.
Looking more at lending risk, how are you viewing that across the sectors at present, and particularly office and retail?
If I start with retail, retail has been suffering for a number of years in the UK in particular. COVID really hasn't helped. So one has to be incredibly careful in terms of the future retail that's coming from obviously internet penetration. We certainly believe that there will be some retail survivors, typically convenience and city centre. So there are some opportunities that are interesting, but one has to be very selective. Office is slightly different in that it's taking a bit longer to see the impact of COVID. Clearly, tenants are locked into longer leases and they've been able to afford the rent. People have been, for the most part, able to work from home. So that hasn't been quite as affected as the tenants on the retail side. But clearly, there will be some change over the next few years, some pressure on rent, some increased vacancy. It will be interesting, but I still think that there's obviously some great opportunities for the right located asset and the good tenant profiles and then the right sponsors. And part of that market, both markets in fact, that we've been fairly active over the last few months have been where there is an existing asset with an existing proven rental income, which might come under stress. So we can obviously structure around that and look at the advance rate or the LTV day one. but also where there's some form of repositioning and in particular planning play. So that's we've done quite a bit on, which we think is very interesting, because clearly, provided that some planning comes through, that obviously creates a pop in value, which means that our LTV goes down quite significantly over time. And again, as a lender, you can always underwrite the downside, which is no planning, what will happen in these circumstances. So we've done quite a bit of that, and that's an interesting space, we think.
Really interesting to get your perspective on the market. Thanks for joining us, Beatrice.
Thank you very much.